Good day, class. Our subject is Basic Accounting 1. Our topic is Adjusting Entries. Acknowledgement. My reference book is Basic Financial Accounting by Wing Balyada. The financial statement, except for cash flow statement, are prepared on the accrual basis of accounting in order to meet their objectives. This means that accountants record revenues as they are earned and expenses as they are incurred. Generally accepted accounting principles required that a business use the accrual basis. So we will be using the accrual basis of accounting. Accounting periods are generally a month, a quarter, or a year. The most basic accounting period is 1 year. A fiscal year is a period of any 12 consecutive months. A calendar year is an annual period ending on December 31. The deferrals and accruals. Accountants use adjusting entries to apply accrual accounting to transactions that cover more than one accounting period. There are two general types of adjustment made at the end of accounting period: deferrals and accruals. Deferral is the postponement of the recognition of an expense already paid but not yet incurred, or of revenue already collected but not yet earned. This adjustment deals with an amount already recorded in the balance sheet account. Accrual is the recognition of an expense already incurred but unpaid, or revenue earned but uncollected. Adjustment for referrals. Prepaid expenses. Prepaid rent. Prepaid insurance. Payment made by the company in advance. Supplies. Depreciation of property and equipment. When entity acquires long-lived assets such as building, service, vehicle, computers, or office furniture, it is basically buying or repaying for usefulness of the asset. These assets help generate income for the entity. Therefore, a portion of the cost of the asset should be reported as expense in each accounting period. Proper accounting requires the allocation of the cost of the asset over its estimated useful life. The estimated amount allocated to any one accounting period is called depreciation or depreciation expense. Okay, 3 factors are involved in computing the depreciation expense. 1. Asset cost. Estimated salvage value. The amount the asset can probably be sold for at the end of its estimated useful life. Estimated useful life is the estimated number of periods that entity can make use of the asset. Accountants estimate periodic depreciation. The simplest procedure is called straight line method. The formula is here. asset less estimated salvage value, the depreciable cost divided by estimated useful life, depreciation expense for each time period. Remember, the asset account is not directly reduced when recording depreciation expense. Instead, the reduction is recorded in a contra account called accumulated depreciation. Remember, contra account. Adjustment for accruals. Accrued expenses. Expenses already incurred but not yet paid. Under the accrual adjusting entries. Accrued salaries. Accrued interest. Accrued revenues. Accrued consulting revenues. Then we had accrual for uncollectible accounts. Effects of omitting adjustment. When an accountant failed to include the proper adjusting entries, the resulting financial statements will not accurately reflect the financial position and the performance of the entity. Inaccuracies in one accounting period can cause further inaccuracies in the statement of subsequent period. Problem for our exercise. Okay. Preparing adjusting entries at year end. Prepare the adjusting entries for Mario Selimin Company under each of the following for the year ending December 31, 2018. Okay. The first adjusting entry, paid 90,000 cash advance on August 1 for 1 year lease on office space. Okay, computation. Adjusting entry number 1. 90,000 advance cash or cash advance for 1 year lease entered as prepaid rent. Okay. From August 1 to December 31 is 5 months period. Compute 90,000 multiplied by 5 over 12 is 37,500. Rent expense. The journal entry, December 31, debit rent expense 37,500 and credit prepaid rent. Okay, transaction number 2. Invested 120,000 in cash in certificate of deposit that paid 5% annual interest. The certificate was acquired on June 1 and carried a 1-year term to mature. Okay, 120,000 time deposit with the bank, 1-year term, and with 5% interest. June 1 deposited. From June 1 to December 31 is 7 months. Computation. 120,000 multiplied by 5% or 0.05 multiplied by 7 over 12 equals 3,500 interest income. Interest income. The adjusting entry, interest receivable, 3,500 and credit interest income, 3,500. Okay, next. borrowed 200,000 by issuing a 1-year note with 8% annual interest to Westmead International Bank on September 1, 2018. So, nag-loan ng 200,000 on September 1, 2018. Computation. 200,000 loan on September 1. 1 year payable. 8% in interest annually. From September 1 to December 31 is 4 months period. Computation, 200,000 multiplied by 8% times 4 over 12 equals 5,333 interest expense. The entry is debit interest expense, 5,333, and credit interest payable, 5,333. Bakit interest payable? Hindi pa nababayaran sa bangko. Okay, number 4. Paid 36,000 for a 1-year insurance policy to commence on March 1. The amount of premium was debited to prepaid insurance. Okay, for the computation, 36,000 payment for 1-year insurance on March 1. From March 1 to December 31 is 10 months period. Computation, 36,000 multiplied by 10 over 12 equals 30,000 interest expense. Our entry, December 31, debit insurance expense, 30,000. Credit prepaid expense or prepaid insurance, 30,000. Okay, ulitin natin. Debit insurance expense, 30,000. And credit prepaid insurance, 30,000. 5. Purchase 8,000 of office supplies on account. At year's end, 1,050 of supplies remain on hand. Okay? Physical inventory, 1,050 remain on hand. For the computation, 8,000 supplies minus 1,050 on hand, 6,950 supplies expense. Debit, supply expense, 6,950 and credit supplies. Number 6, transaction. Receive 30,000 cash advance for a contract to provide services in the future. The contract required a 1-year commitment starting May 1, 2018. Okay. Tumanggap ng cash advance from customer. Commitment starting May 1, 2018. Our computation, 30,000 cash received in advance from customer. May 1. From May 1 to December 31 is 8 months. 30,000 multiplied by 8 over 12 equals 20,000 service revenues to be recognized. Re-recognize na yung revenue. December 31, our adjusting entry, debit and earned revenues, 20,000, and credit service revenues. Okay, number 7 transaction. Paid 360,000 cash to purchase delivery van. On February 1, 2018, the van was expected to have a 5-year life and a 10,000 salvage value. Depreciation is computed on a straight line basis. Okay, our computation, 360,000, the cost of delivery van. Date of purchase, February 1. 5 years, useful life. 10,000 salvage value, straight line method of depreciation. 360,000, the cost, minus 10,000 salvage value. 350,000 divided by 5 for 5 years, 70,000 per year of depreciation. 70,000 per year. Acquired on February 1. From February 1 to December 31 is 11 months. Okay. 70,000 multiplied by 11 over 12 equals 64,167 depreciation expense. Our entry is debit depreciation expense 64,167 and credit accumulated depreciation 64,167. Okay, transaction number 8. Payroll for the 5-day work week to be paid on Friday is 200,000. The last day of the period is Thursday. 200,000 payroll for 1 week. Friday ang payment date. Okay. Thursday, last day of the period, December 31. So, yung December 31, tumama ng Thursday. From Monday to Thursday is 4 days. Computation, 200,000 multiplied by 4 divided by 5 equals 160,000 salaries from Monday to Thursday. Payroll for the week for 5 days work only. Monday to Thursday. Salary expense, December 31, which is Thursday, 160,000. Adjusting entries, debit, salary expense, 160,000. And credit, salaries payable. Salaries payable, sa Friday pa babayadan. Okay? The last transaction, number 9. Services totaling 12,000 had been performed but not yet billed or recorded. Not yet billed or recorded. So, i-record lang to. Parang normal recording lang. So, December 31 ang debit. Account receivable, 12,000. And credit, service revenues, 12,000. Okay? Thank you, class.